Of course, there are two big things. We want to start on Fed and China, but these data, investors everywhere are watching. What do you see there? Base effects that pull down the numbers and take some of the steam out of there, or underlying aspects showing that China's still chugging ahead?
Right. Well, obviously the base effect will pull down some of the headline numbers, but obviously we have to look past that. I think the most interesting data really to watch is what happens to real retail sales in China, because if you look at the last round of data, one of the surprising things that came out of China was if you take out the base effect and look at a 2-year average, retail sales actually disappointed in China. So this kind of subdued consumption recovery in China was kind of in contrast to what people were expecting. So we'll see what happens to this upcoming data. Now, we are actually below consensus in terms of our forecast for retail sales because we are a little bit more concerned that the recovery in retail sales is a little slower. I think in this round of data, there should be a little bit of recovery on the services demand because over the last month and a half, China has really accelerated vaccination. So hopefully that should pick up some of the data on the services component and catering services. But on the flip side, auto sales is still weak. So there seems to still be a little bit of a holdback on some of the goods trade. The other data that will be interesting is industrial production. I mean, I think one of the things that we've seen in China was kind of the disappointment in industrial production because China was obviously pursuing some of the decarbonization efforts. And so we had some cuts in capacity like steel. So I think we're expecting we should see a little bit of improvement in the May data, although, of course, Y&Y will still look lower. But overall, the underlying data will show a little bit of improvement. And we've already seen like a 0.5 percentage point increase in the PMI manufacturing data out of China. And the hope is that with the sharply rising input prices like steel, they might ease a little bit on some of the production cuts that we saw in April. We might see a little bit of a easing in May. And then, fixed asset investment, I think investment should still look fairly okay, fairly strong. I think we're seeing a little bit of pickup in infrastructure investment. Property investment should still be resilient. But I think, overall, the story in China that I'm curious about is really to look at the underlying consumer story, the retail sales. And so I think because China has a very divergent path to what we're seeing in the U.S., where, I mean, for now, we don't really worry so much about the CPI inflation pressures out of China.
Right. So in a nutshell, though, are these numbers still strong enough for the government to say we don't have to keep bolstering liquidity? I mean, the MLF facility addition last night was considered, or yesterday, a little bit disappointing, the 7-day repos. Which case does it support when it comes to adding liquidity?
Well, we have to remember that part of what's driving monetary policy is not just the pace of the economic recovery. China has already been directionally, marginally tightening its credit policy since late last year because of financial stability reasons, right? The desire to manage kind of leverage. And I think that sort of process of gradual tightening on the credit front, I think is still going to be an ongoing process, throughout this year. I think the last credit data that we saw was a little bit better than the previous month, but overall, directionally, China is at the margin still tightening on the credit front. I mean, I think the rollover of MLF was pretty much, in line with expectation. I think they still want to manage liquidity on a neutral basis. But again, China has multiple policy tools to guide its monetary policy front. And because China recovered earlier and there's more concern about financial stability, they obviously normalized. Some of their normalization of policy is not based on the price of credit, like interest rate, but more on the quantity of credit and liquidity. And certainly on the credit front, we've already seen a tightening of credit impulse. I mean, really, it started since late last year. And I think that will still continue this year. And the data that we're seeing in terms of, still, kind of uneven recovery, but still a recovery nonetheless, will still continue on in this path.
Johanna, I think it's really interesting kind of probing the reasons that central banks feel like they may need to move soon that are beyond just reflation, right? Take a look at this chart, taking a look at loose monetary conditions, right? We are looking at 3 measures that point to the loosest financial conditions since the 90s, and obviously that is pushing up risk asset exuberance. And this is not just easy monetary policy, right? This is also liquidity as well as market sentiment.
Yeah.
Is this a good gauge for what central bankers would be thinking, for systemic stability, we may have to move or at least talk about normalizing sooner rather than later?
Well, I think obviously we also look at financial conditions indices. So it is a useful tool and gauge to also assess, policy stance. But we have to remember different central banks have different approaches to how they address financial conditions and financial risks. Some central banks, for example, for example, New Zealand, where people worry a lot about housing prices, there's more bias to using macroprudential policy tools rather than monetary policy instruments as a way to address some of these risks. But then on the other flip side, for example, we moved our call on Korea. So we now actually think Bank of Korea will move earlier. And what's driving Korea, I mean, of course, economic recovery is better, but I think one of the motivation is I think Bank of Korea is a lot more concerned about financial stability and is more willing to use monetary policy tools because it sees low interest rates as a concern or a problem. And I think in China, or PBOC's policy framework, the fact that it clearly shows that they also care about financial stability. And that's part of the reason why we've already seen a tightening of credit. Now, the question is, different central banks have different kind of mandates, different objectives and policy approaches. Some would rather use macroprudential policies rather than using interest rate policies, which it perceives as more blunt. But other people argue that, interest rate is an important tool for risk taking and they should use it. So again, it varies and depends on where you are in the leverage cycle and what are the other tools that are available to you. So again, it's not a one size fits all, but clearly, I think, there are, certainly financial risk taking and asset prices is something that market is very, very attuned to. And the most important, I think, central bank in terms of a provider of global liquidity and risk assets is the Fed, which is why everyone is so focused on the upcoming FOMC meeting and what they're going to say.